Hello, 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 check, hello, okay. Okay. So hello all. I am Sandeep from EduPristine, and today we are going to have a session on options, basics and training strategies. So first of all, please confirm if I am audible and you are not facing any technical issues. You can just put it in the question box or the chat box. Just confirm if I am audible. All the attendees, you can use the chat box or the question box. Okay. Yeah. Let's ensure that there are no technical difficulties before we proceed. So if you have any issues, put it in the question tab and I'll try to resolve them. Okay. Any issues regarding the audio or the PPT, please post it in the question box. If it's okay with you all, I'll move on to start the PPT. Okay. Okay. So yeah, the response from you all shows that there are not really any difficulties. So let's move on to the PPT then. The topic for today is options, basics and trading strategies. This is the topic which is actually both in CFA syllabus and FRM syllabus level 1. The basics of options are included in both, while the trading strategies, which is slightly more advanced, is only in FRM level 1 syllabus. So initially we'll look at the basics of options, which is both from a CFA perspective and an FRM perspective, and then we'll move on to the trading strategies, which is slightly more advanced. So first, a brief introduction about us. EduPristine, we are leader in training for finance, and we are authorized by the CFA Institute, the CARP, which is the FRM Institute, and the PRM Institute. We serve a market client list, which includes JP Morgan, Bank of America, Ernst & Young, IIM Calcutta, etc. A brief introduction about me. I am Sandeep, and I am the part of content development team in EduPristine. Today, I am going to take you through this webinar, which I hope is going to help you all. So, here's the session agenda. Before this, I would like to confirm again whether I am audible and you are not facing any difficulties. Please post it in the questions tab or the chat tab so that we can get started with the session. Okay. Okay. So yeah, it seems that I am audible to all of you. So let's go on with the session. The agenda, basically, we have two parts in this webinar. The first part will deal with the introduction to options, wherein we'll look at what the options are, or how they are valued, what's the put call parity, what are the bonds for the option values, and some special cases. In the second part, we'll talk about the options trading strategies. We'll talk about some popular trading strategies like covered call, protective put, spread strategies and combination strategies. These are regularly employed by traders to make money. So let's get started then. Part 1. This is the introduction to options. Options. What are options? They are the contracts which give you the right. The right is the important term, right to buy or sell a particular asset. It is at a pre-decided price and a pre-decided date. This pre-decided price is called the strike price. And this gives the right to the buyer and not the seller. When the buyer wants to execute the option, the seller has to oblige. So what does the seller get for this? He gets an option premium from the buyer. So that's kind of a payment to buy the option. So we have basically two kind of options. First is the call option and second is the put option. The terminology is pretty simple. Call option, it represents the right to buy, the option which gives you the right to an asset. And the put option, it's the opposite. If you buy a put option, you get a right to sell. And now there are two other classes of options which are called the European options or the American options. The European options, again in European options you have call options and put options. Similarly in American options you have call options and put options. European options, in case of European options, the major thing is they can be exercised only on the expiration date. And in American options, the basic difference is they can be exercised on or before the expiration date. And now let's talk about the positions. Initially, I'm trying to get you through the terminology, get you familiar with the terminology so that we can understand better in the future slides. Positions, there are two kinds of positions in an option transaction. One is a long position and other is a short position. Long position basically means you are an option buyer. That means if you buy an option, you are in a long position. And if you sell an option, you are in a short position. These are basically the terminology that we have. The pre-decided price is called the exercise price or the strike price, and the pre-decided date on which the option is exercised is called the exercise date. So what are the factors that affect the option value? These options are basically issued on the underlying securities, underlying assets. What are these underlying assets? Its options are basically like gambling, some sort of gambling, where you bet on something. That something is called the underlying asset. Suppose you bet that a stock price is going to increase. So the stock herein becomes the underlying asset, and the option is called the stock option. If you bet on bonds and other securities, they become respectively the bond options or the other options. So the factors that affect the options value, here is a summary that I put it. The call and put, there are two kind of options as I already said, call and put. The stock price, if in case of stock options, the stock price is obviously the first factor that affects the call and put prices. If the stock price increases, call price increases. Why? Because call gives you the right to buy. So if the stock price increases, you have a better chance of earning profit because the exercise price is fixed and you can use it and you can buy the option, the stock at that price. So if the stock price increases, you have better potential of earning profit. So obviously the option premium that you pay will also be high. Thus call price increases and the put price, which is the opposite, decreases. It's the same case with the exercise price. Exercise price, if it increases, the call price decreases and the put price increases. Similarly, volatility. Volatility is basically the deviation from the stock price today. So if the deviation is more, obviously the option is more valuable because you're betting on either increase or decrease. So if the volatility is more, the options are more valuable. Similarly, the time to expiration, as the time increases, the uncertainty increases, so the volatility increases, so the call price and the put price increases. In dividends, when a company pays a dividends, the stock price comes down. So the effect will be opposite of the stock price. So the call price decreases and the put price increases. These are essentially the factors that affect the value. So let's take an example to make it clear. Here we have a stock option and we are asked the risk-free rate effect, increase in risk-free rate effect on an American put option. So as we can see from this table, on an American put option, if the risk-free rate increases, the put price decreases. So the effect will be negative. At this juncture, I would like to confirm whether I am audible to everybody, whether there are any kind of issues. Please post it in the chat box or the question box to confirm if I am audible, so that we can proceed forward. Okay. Okay. So yeah, it seems like I'm audible. So I'll proceed forward. Now let's look at the value of options. Options, they basically have three kinds of value based on what their payoff is. If an option, basically if it gives a zero payoff, if it is exercised immediately, then it's called at the money option. That is, if the strike price and the price of underlying are the same, then if you exercise it immediately, you don't get any profit, you don't get any loss. So the payoff for you is zero. Such an option is called at the money option. In the money option is something which gives you a positive payoff. In case of call option, if the price of the stock is greater than the strike price, then if you sell it immediately, you get a positive payoff. So such a call option is called in the money call option. In case of put option, we need the price to be lesser than the strike price for a positive payoff. So in that case, an option which has stock price less than the current strike price has a positive payoff and is said to be the in the money option. Out of the money, it's just the opposite of in the money. If it gives you a negative payoff, it is called out of the money option. So let's now try to plot the payoff graphs of both call and put options, both from buyer's perspective and seller's perspective. For this, I have taken a small example to illustrate. Here we have an option of some company, XYZ Corporation, with a strike price of 5. Let's say the price is expected to range from 0 to 10. So here's a table which I plotted, which shows the call value and the strike price. So here the call is not valuable to you unless the stock price goes above 5, because the strike price is 5 and you want to buy the option, you have a right to buy the option. So as a rational thinker, you'll buy the option only if the stock price exceeds 5. So in case of 6, 7, 8, 9 and 10 values, will have call value respectively as 1, 2, 3, 4 and 5. And the put value, it's exactly the opposite. For the put value, we have a right to sell, and we'll sell the stock at 5 rupees or $5 only when the stock price goes below 5 to earn some profit. So in case of a call, until the break-even point, which is the strike price, until 5, we get a 0 payoff, and then on it increases linearly based on the stock price increase. Thus, we can plot the call payoff as shown. In case of put, as I said, it's exactly the opposite. But then the thing to remember is cannot go below 0, the stock price. So it will always stop at the 0 point. And on the other side, if it is greater than 5, then you have the put option is worthless, so you have 0 payoff there. So thus we can plot the payoffs for different options. Long call, long put. Here we are buying the call and buying the put options. So as I illustrated, here are the gaps for call and put options. From a seller's perspective, we can see that it's exactly the opposite. When the payoff is 0 here, it's 0. When it is positive, this guy is gaining, so this fellow will lose. So for this guy, if it is +5, it will be -5 for the seller. Similarly, we can have in case of put option also. It's exactly the opposite. So what are the returns to the option sellers and option buyers? What's the motion? For option sellers, obviously, for underwriting the contract, they get a premium, which is called the option premium, as I mentioned earlier. So let's take different scenarios and see how it is profitable to the sellers. Here I took an example where the option premium is 1 and the strike price is 5. So an option seller, he makes a profit if the stock price is less than 5 at the time of expiration. Because if the spot price is less than 5, the call will not be executed with the buyer, by the buyer, and this guy makes a profit of 1, which is the premium that he got for selling the option. Again, he may get a profit still if the price exceeds 5, then it is less than 6, which is the difference should be less than the premium that he is getting by selling the option. So here the premium is 1. So if it is less than 5 plus 1, which is 6, he'll still end up gaining some profit, which is obviously less than 1. But if the stock price goes above 6, the writer will get losses. And 6 is a given point where he gains no profit and he doesn't make loss exactly, because at 6 the exercise price is 5, so the option will be executed. The call buyer will make 1 rupee profit or $1 profit, and since he already had to pay 1 rupee premium or $1 premium, the gain will be nil for both the buyers and the sellers. So the payoff and profit are slightly different. Here I plotted the profit graphs, which is slightly different, which is slightly shifted from the payoff graphs. In case of call profit, earlier we saw that in case of a seller, we had from 0 till 5 and it went down. Here it will slightly shift. The shift is basically the option premium. So if the option premium is 1 rupee or $1, it shifts up by $1. And in case of put, it is the same. The shift will again be determined by the option premium. And here's a table based on which we plotted the graphs. Similarly, in case of long call and long put, I try to plot the graphs. Again, it's basically the payoffs that I showed earlier and the shift which gives the profit graphs. Now, here's an important concept. Before this, I would like to confirm whether I am audible to everybody. Are there any technical issues? And am I good to proceed? You can just comment on the question tab or the chat tab so that we can proceed forward. Okay. Okay. So yeah, it seems that I am audible to everybody. So we'll proceed on to the important concept, which is the put call parity. Here, I'll try to give you an example and explain. Let's consider a person who has the following portfolio. He has a call option with a strike price of 5 and a bond which gives him 5 and which is completely risk-free. So at the maturity, he'll get $5 in his hand without any kind of risk. So in that case, the payoff to this person, if the price of the stock at expiration is less than 5, he won't execute the call, so the call payoff will be 0, and he'll anyway get constant 5 rupees or $5 from the bond. So the net payoff that he gets will be 0 plus 5, which will be 5. For the values which are greater than 5, he'll get some payoff from the call plus the constant 5 from the bond. So the net payoff is as shown: 5, 6, 7, 8, 9, 10. Let's take another portfolio. This is another trader who has a portfolio as shown. What he does is, he has a put option with a strike price of 5 and underlying asset, 1 share of stock, the same stock on which he has a put option to. So here, the put will pay him if the share price is less than 5, as we discussed. And the stock payoff, it will depend on the stock price. So if the stock price is 0, 1, 2, or 3 or 4, the put will pay him accordingly, and the stock will give the same as the price at expiration. So the net payoff, if we see, it is again the same as the previous portfolio that we discussed. Here we had from 0 to 5, we had 5. Here also from 0 to 5, we had the same return, which is 5. From 6 to 10, we had 6 to 10, and here also from 6 to 10, we had the same payoff, 6 to 10. So the payoffs are exactly the same in both the portfolios. So the law of one price, what it says is, if the payoff is same, the price should also be the same. Thus, we use the put call parity to get a relationship to determine the prices of call and put options. So the relationship that can be expressed is as follows: the value of call plus the present value of strike price is same as the value of put plus the share price. Because this is the representation of the first portfolio, this is the representation of the second portfolio. And as we saw, the payoffs are same for both, so we'll have the same prices for the both. So the mathematical equation can be put this way. The premium that we pay for call plus the strike price present value, which can be discounted. If the time is t, we can discount the strike price as x by 1 plus r whole power t. Or if we have continuous compounding, we can write it as x e power minus rt equal to the stock price plus the premium. Till now, we have assumed that the stocks are non-dividend paying. In case of dividends, the change is pretty simple. In case of dividends, the stock price will go down by the dividend, amount of dividend that you pay. So what we do is we subtract the dividends from the stock price, or we can add it to the call to the side which has the call option. So the equation can be roughly put into this: call plus present value of strike price plus present value of dividends will be the same as stock price plus the put premium. Here the point to note is this put call parity is valid only for European options. For American options, this turns into an inequality, which is the left hand side will be greater than the right hand side. So let's take an example to understand the put call parity. Here we try to determine the put option value. We try to find what it is equivalent to. Remember, these examples that I'm giving are either the CFA level 1 questions, PAR or FRM level 1 questions. So these questions are on par with your examination questions. If you have any doubts regarding the questions, you can put it in the questions tab. Now I'll try to explain this example. This is pretty simple. This is based on the equality that we got from the put call parity equation. Here, to find the value of the put, it is simply shift this to the right hand side. So what it says is you have to buy a call, you sell a stock, and you buy a zero coupon bond. So which is option B. So B is the right answer for this. Okay, let's move on. Let's take another example. Here we have the strike price, we have the call option value, and we have the stock price. We are also given the risk-free rate, and we are asked to find the put option value. Again, we use the same equation, and once you substitute the values, you can get the option easily. Okay, let's move on. So while determining the option values, we have to take care what are the minimum and the maximum possible values. Because many questions in CFA and FRM, they try to question based on the minimum and the maximum profits or losses that you can make. So the option bonds that you have are really important to know. Before this, I would like to confirm if I'm audible. If there are any problems, please put it in the chat box or confirm if I'm audible. Okay. Okay. So yeah, it looks like I'm audible. So I'll proceed forward. Here, let's consider a call option. Again, the same one. The strike price is 5 and the share price, if it is below 5, the call will be worthless. If it is above 5, it will be worth the value of the stock minus 5. So here's the graph that I plotted. This is the minimum barrier where the call will be worthless, and this is the maximum barrier, which is based on the payoff. So the value of the call will be somewhere in between these two. Similarly, we can see that for the put option also, based on the payoff, we'll have two barriers. One is the minimum and the maximum, and the value will lie in between. So here's the table which shows the bounds of the and the option values for European call, American call, European put, and the American put. In case of European call, the minimum value is at least 0 or the difference of the stock price and the exercise price. And the maximum value is obviously the stock price, because if the call value exceeds the stock price, then there is a possibility of arbitrage. So to avoid that, the maximum value should be less than the stock price. In case of American call, it is pretty similar. Similarly, for the put, it is the opposite. It is the strike price minus the stock price. And the maximum value will be the strike price instead of the stock price. Okay. Till now, we have covered the basics of options. Now, let's move on to the options trading strategies, which is slightly more advanced. So, let's get started. In traders, what they do, they use different kinds of strategies based on the expectations of the prices of the stocks that they have, the risk they are ready to take, and availability of contracts. So here are some popular strategies that I'm going to discuss. The first one among them is covered call. A covered call, in covered call what you do is, instead of simply buying a stock, you also sell call options on the stock that you own. So thus what you have is, you get the option premium by selling the call options. So you lower the cost of purchase. In this, the motivation is, you try to lower the cost of purchase of the stock. For example, if the stock costs you $30, then by selling a call option for $2 or $3, say, you lowered the cost of acquisition to $27. And thus, what you did is, you increase your profit and also you limited your losses. Because here I used an example to illustrate, to compare the net profit and loss by using this strategy when compared to a simple stock purchase. Here we have a stock which has a current stock price of $33, and we have sold strike price 35 calls at $1. So when you see the profit potential, when the stock price is less than $30, say $30, if you simply buy the stock, you will get a loss of $3 per share, and you have 100 shares, you have $300 loss. But since you sold the call options, in this case, you get $1 per share, and so $100, which lowers your loss to $200 instead of $300. So here what you are basically trying to do is, we are trying to limit our losses by sacrificing gains when we by sacrificing at the upper end. For example, if the stock price exceeds the $35, then still the gain that we get will be stuck at $300. However, if you simply buy the stock, you will gain $400, which is greater than 300. So here, the payoff, what you are trying to do is, our expectation is the stock will moderately rise, which will be less than the strike price, but greater than the current stock price. Thus, you are trying to gain more than a simple stock purchase while also limiting the losses. The second popular strategy that people use, traders use, is the protective put. Here, what we do is, we have stocks and we buy put options. Instead of selling call options, which we did in the other strategy, we buy put options on the stocks that we already bought. Here, again, the objective is same. We try to limit the losses by sacrificing gains at the other side. Here also, what we expect is a rise in the price of the underlying. If the stock price falls, we are still trying to sell at the strike price, and thus we are ensuring our profit. Now we move on to the spread strategies. In spread strategies, what we do is, we use multiple call options or multiple put options to generate a payoff which will give more gains than owning a simple stock. Here, what we do is, here again the motivation is, we are trying to protect the downside risk by having a limit on the upside. Again, it is similar to the strategies that I discussed earlier, which are the covered call and the protective put. Here, the expectation is also the same. We expect a moderate rise in the price of the underlying. Here, what we do is, we purchase two call options, one at a lower strike price and another at a higher strike price, but both having the same maturity. The first, the one with the lower strike price, is one which we purchase, and the higher strike price is the one which we sell. I'm sorry, I said it is purchasing both, but it's actually we try to purchase the one which is having a lower strike price and sell the one which is having a higher strike price. Bullish belief means we are expecting a rise in the price. So if we expect a rise in the price, what we say is, we try to purchase a call option at the lower strike price, so that if the price increases, we can execute that option and gain a profit. But also, we are trying to limit the gains and the losses by selling the call option at the higher strike price. So here, the payoff graph is something similar to this, which I plotted. Here, we have limited the downside risk while sacrificing the profit on the upside. The payoff will be maximum when we get what we expected, which is a moderate increase in the share price. We can have bull put spread also, which is similar to this, where we buy a call option at a lower strike price and sell a put option at the higher strike price. That is, buy a put option at the lower strike price and sell a put option at the higher strike price. Again, the payoff will be similar to this. We are limiting the downside risk and while sacrificing the upside profit potential. The bear spread, it's exactly opposite to this. In bear spread, what we believe is, we believe that the price will go down, but the stock will go down. So how do we protect this? We we can do it using call options or put options again. Using put options, what we do is, we purchase the put option with a higher strike price and sell the put option with a lower strike price. It's exactly the opposite. If you take the call option, we sell the call option at a lower strike price and purchase the call option at the highest strike price. What it does is it gives this kind of a payoff. Again, it is essentially the same. We are limiting the downside risk while sacrificing the profit potential on the upside. At this point, I would like to confirm if I'm audible, and if there are any questions, you can put in the questions tab. Okay. 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 So yeah, it seems like I'm audible to everybody. So now we'll move on to this butterfly spread. Here, this is slightly more complex when compared to the bearish spread or the bullish spread. Here what we do, we have three different call options. First, we sell two call options at some strike price, say P. And then we buy a call option which has a higher strike price, and also we buy another call option which has a lower strike price when compared to this. By doing this, what we are trying to do, we are trying to again limit the losses on both sides, and will again profit if the stock price doesn't change much. Here what we did is we also took care of the direction. Here we are not sure of which side the stock is going to change, but what we expect is there is not much change on both directions. So here the payoff graph is something similar to this. Here we'll profit again if it is as expected, which is the stock price doesn't change much on both directions. If it changes, and if it increases significantly or decreases significantly, we have limited the losses as shown. So this is one strategy. Now we move on to the combination strategies, wherein we use both call and put options on the same underlying stocks and try to come up with strategies. Here the popular strategies include straddle, strangle, strap, strip, etc. So let's see what straddle means. In straddle, what we do is we buy both a call option and a put option which has the same strike price and the same maturity. So here, when do we do this? When we expect a large change in the price of the underlying. The change can be on the upside or the downside. Here we took care of the direction. So unlike the spread strategies, wherein we don't expect much change in the stock price, here we expect a large change in the prices of the underlying. So in a straddle, a payoff looks something similar to this. Here we have limited the losses when there is not much change, but will gain if it increases significantly or decreases significantly. Long strangle is similar to straddle. Here the only difference is there is some difference between the call and put option that we buy. The strike price is slightly different. So instead of a pointed end that we got here, we get a line here. Again, we have limited the losses when the stock price doesn't change significantly, while we are making profits if the stock price changes significantly on both sides as expected. Finally, we move on to strap and strip. Strap and strip are slightly more complex when compared to strangle. Here, instead of buying one call and one put, we buy multiple calls in case of strap and multiple puts in case of strip. Basically what this means is, again we are expecting a large change in price, but in case of strap what we expect is the price is expected to increase more rather than decrease. So there is more probability for the price to increase significantly. So here what we do, since we expect the price to increase more, we buy multiple calls, say 2 calls, and buy only 1 put. So again we have the same strike price, same maturity, everything is similar to strangle. This is, we can say, a more bullish version of the straddle or strangle. Here the payoff is something similar to this. There we had symmetric graph. Here it is asymmetric, and the gains are more when there is upside gain when compared to the downside gain. Again we have limited the losses. We get an asymmetric plot which gives you more profits on the upside. The strip, it's simply the opposite. We are having a bearish expectation, which means the price is expected to decrease more than increase. So here we buy multiple puts, say 2 puts for every 1 call. Here the payoffs is something similar to this, where we have more payoff when it is on the downside when compared to the upside. Finally we have the bond, wherein you want to deadlock at any cost your profit. So what we do is we combine a bull call and a bear put spread, for which the payoffs are as shown. When we have a profit in case of bear put, we have a loss in case of bull call, which ultimately ends up giving you the risk-free rate of return. So you'll stay in between, and this simply behaves as if you have invested in a bond. If you buy a bond, treasury bond say, which gives you a risk-free rate of return, this strategy will ensure that you get a similar kind of return. So here are some example questions, which are simply the applications of the strategies that I discussed. In the first question, we want to lock in a profit, and we have the call priced at 16 and the put option priced at 3. The strike price is 260 and the current stock price is 280. So if we buy a call option and exercise it immediately, the cost that we incur is 260 plus 16, which is the cost of buying the option, which totals 276. And if we sell the futures contract, we gain 280 and we have immediate gain of $4. So the option D is right answer here. In this case, it's basically the application of the bullish and bearish spreads that I taught here. These questions are for your practice. I have attached the solutions. Now we'll have a 5-minute recap of what we discussed in the trading strategies. We have discussed the bull call spread, the bear call spread, the butterfly spread, and the combination strategies. In case of bull call spreads, what we expect is there is a moderate increase or a moderate decrease in the stock price, and we expect that the stock price more or less remains the same, it doesn't change significantly. However, if we expect the stock price to change significantly, we will employ combination strategies like straddle, strangle, strap, or strip. If we are more bullish on the straddle thing, we'll use a strap. If we are more bearish, we'll use a strip. So basically this is what the traders do. And they use one of the strategies to make money. As I said, options are an advanced version of gambling, if I may say this. And so this concludes my presentation on options. Here are the links that I have attached of the blogs of the other recent webinars that we conducted recently. We have conducted some webinars on linear regression analysis, understanding income statement, hedging strategies using futures very recently. And the blog links for this are as shown. I'm going to mail you all this PPT for your benefit. You can use the questions to practice, and you can go to the PPT again and understand the concepts thoroughly. And we have upcoming webinars scheduled. One is on 18th and the other is on 20th. The registration links are as shown. You can register for them if you have liked. They are going to be very helpful for your CFA and FRM preparation. And you can have more webinars. You can look forward to more webinars from our side. Just drop us a mail to suggest a topic and we'll be on it. We'll be trying to address your questions. And we have classroom training coming up in New York very soon, probably in the first week of May. And we have a crash course or a review course of CFA and FRM just before the exam, which is going to be in May. The FRM exam, which is going to be in May, and the CFA exam, which is going to be on the 1st June. We'll have a review exam, review course, which will be a 4-day course, which will help you revise the concepts and help you better prepare. So, thank you for your patience. This is Sandeep signing off. Thank you all. Before signing off, I would like to ask if there are any questions related to the PPT, related to the webinar that I taken just now. And if you don't have any questions, I'll sign off. Just confirm in the questions tab if you have any questions. Okay. So, okay, this is not an exact representation for the classes conducted. This is actually a summary of the classes that we are going to have. The classes will be more in detail. This is an attempt to make you familiarize with the concepts and help you better understand. In the classes, we'll have a detailed explanation of all this. We'll have the basics properly understood, properly making you understand. And in classes, we'll go through the concepts more in detail. And so that's it. This is basically to help you to have a summary, to have a basic understanding of the concepts. So that is it. Sandeep signing off here. Thank you. Thank you all for listening. Thank you. Okay. Yeah.
The organized